I would say that the biggest thing to overcome is probably not too different for anyone else. Is it sounds like a great alternative.
What was the hardest thing to overcome? Because being in the multifamily industry for a while and maybe doing 1031s, or maybe you hadn't done any 1031s in regards to your syndications, what was the hardest thing to overcome for the Deferred Sales Trust? Because I know for me at Marcus and Millichap, this was like 11 years ago when I first heard about it. I'm like, I was selling multifamily deals, doing 1031s with clients, and we're like, "What? This seems like too good to be true." Or how is it really going to be work for me? What was the biggest challenge for you to overcome, David? And then what is it like now that the trust has been closed, and how's it working out?
Yeah. So I would say that the biggest thing to overcome is probably not too different for anyone else. Is it sounds like a great alternative, but what's the catch, right? And I would say, the catch really is number one, really understanding how it works and getting comfortable with it. Number two, I would say that the paperwork was pretty easy. We thought, you surrounded yourself with a good group of advisors, Robert Kelly, as well as Todd Campbell on the legal side, and so a good team that will take the time to sit down and or have a phone call. In Robert's case, we met him for lunch, but a good team that really knows what they're doing, and so that's really helpful. I would say what would be something that would be, and don't want to say it's a negative, it's just a learning curve, right? And that is taking that money and reinvesting it in deals, our own deals, right? It's a little extra paperwork, yes. However, it's worth it because you can take that money, delay avoiding taxes, and really be able to use that money tax-free, obviously, until there's some sort of a liquidation event, but grow that money, prior to paying taxes, just like kind of a self-directed IRA, right? It's really nice to be able to do that, and it provides us the ability to grow our business.
Yeah, absolutely, 100% right, and that's what we pride ourselves on, giving you some more access to capital, deferring the tax, right, versus the 1031 exchange, which can be very kind of challenging. In 99% of the syndicators we work with do not 1031. They don't allow 1031 money in, nor do they do it out because it's just too complicated. But the Deferred Sales Trust is very, very flexible, and it allows each individual to kind of go their separate ways and then to have their own Deferred Sales Trust to go back into more deals. And you can learn more about that at capitalgainstaxsolutions.com. That's capital. All right, everybody. Hey, welcome, welcome, welcome. For those who are joining for the first time, my name is Brett Swarts. I'm founder of Capital Gains Tax Solutions, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a deferred sales trust is a great way to exit highly appreciated real estate, business, cryptocurrency, primary homes, save a failed 1031 exchange so you can create and preserve more wealth, or help your clients, friends, and family do the same. I'm excited for today because we're going to be talking about a deal close story of the week, which you just heard from David Sloan, a client of mine. He closed his fourth deferred sales trust, so that's coming up here in a moment. But I'm also joined by the amazing and great financial advisor. I call him the CPA Whisperer, Jake Miller. Jake, how are we doing?
Doing great, Brett. Glad to be here. Always a good time.
Excellent. And also Pierce York, a podcast extraordinaire now. He's running the podcast, realtor down in Newport Beach, and part of the Capital Gains Tax Solutions team. Pierce, how are we doing?
Good, Brett. How are you?
Phenomenal. So,
Awesome.
So with kind of our vision here today is to kind of give you guys an overview of the Deferred Sales Trust as well as the deal close story of the week. And then answer questions, open it up for everybody. It's like a masterclass, a mastermind, and we want to make these things simple for you. We always use the analogy of a Rubik's Cube. Everyone's situation is a little bit different, and we're in the business of trying to solve this so that it can meet your guys' vision for your wealth plan. And the tax thing being at the center, a big challenge of that is the bigger tax, the bigger the pain, the more we can add value. And our goal is to make this as congruent for you as possible so that maybe at some point, maybe not ever going to be perfect, but you can have entrepreneurial freedom, you can have financial freedom, you can have time and energy freedom. Maybe you can lower some of your stress. Maybe you can diversify away from from highly appreciated positions. We'll talk about cryptocurrency, what's happened in this last few days. It's been pretty brutal out there, and this is exactly why the Deferred Sales Trust makes so much sense right now, and that you can exit high, diversify, and sit on the sidelines and buy low, which is what we call optimal timing, which is at the center of everything that we do here at Capital Gains Tax Solutions. And part of that was because of the 2008 crash, when people who had overpaid for real estate lost half, some lost all, especially here in Sacramento, California is one of the biggest boom bust cities in America. And I saw the pain firsthand from clients who had done what's called these 1031 exchanges and were over-concentrated, had too much debt, not enough liquidity, and really came out of the other side with a lot of pain and a lot of the opposite of freedom. It was actually kind of turmoil and struggle. And so this is the center of why we're here. And we want to help you, whether it be your crypto holdings, your real estate, your business, your primary home, anything that you're looking to exit. We want to help to hopefully build a dream team around you to help you, or work with your dream team to execute on the Deferred Sales Trust, so that perhaps your goals and your vision for your wealth and your time and your energy is as congruent as it can be. That being said, Jake, anything else to add on the vision for why we're here?
I think you hit the nail on the head, Brett. Anybody with a highly appreciated asset, whether it be crypto, business, shares of a company, whatever, real estate, we're talking to a lot of interesting people, even individuals with warrants right now that will have a reverse IPO and will have, a 6-month period of which then they can exercise those warrants into stock. A lot of interesting situations. Not everybody's the same. I think the magical thing that I would add is just the fact that the Deferred Sales Trust as a financial tool is flexible and should be customized to the client's situation.
Absolutely. And so that being said, let's dive right into the deal close story of the week. And so this gentleman, you actually heard him on the video here. He is a client who not only did it for his first property, which was in Las Vegas for $20 million, but he went on to do it for another property in Phoenix for his second deal. They did another one in, what was the third state? I think it was another one in Arizona as well. And then this fourth one also in Arizona. And so I'm going to share my screen to kind of give you guys a visual of what this property looks like. And I did a social media post. By the way, if you're not with me on Instagram yet, give me on Instagram and LinkedIn. And I'm actually going to readjust my setup here. Jake, in the meantime, would you talk about the cryptocurrency deal that we did close while I readjust and get everything set up here?
Absolutely, not a problem. And just, for time's sake, there are several different cryptocurrency deals that we're working with on these individuals, even a couple NFT deals. And they're all treated a little bit different. The one that we've closed that has gone through very successfully, and that the individual not only has utilized the Deferred Sales Trust to defer the capital gains on that asset, but has also reinvested. This is a great story. This individual was an employee of Google, invested $50,000 several years ago. That $50,000 went to $50 million. She decided that maybe she didn't need to work for Google anymore, that she had other aspirations and dreams in life. She had a consultant that helped her scour the country and try to find the various options for how to handle the tax ramifications. She had the full expectation of having to pay a very large tax. At the end of the day, we were able to assist her. She chose us as the dream team, and we were able to assist her to roll over $5 million of the, at that moment, $50 million into a Deferred Sales Trust, of which she was able to take $4 million and invest in a side business that was a passion of hers, while simultaneously putting $1 million into marketable securities, of which we're sending her a $15,000 check every month to live on, and she's very happy and pleased with the result.
Yeah, and with that too, right? Given what happened with crypto, before we get back into the real estate deal, I think it's wise, Jake, to talk about what's going on, right? I mean, it's kind of blood in the streets right now. Maybe the biggest crash. I don't know how it ranks in crypto history, but as far as billions and billions, I think it was $200 or $300 billion was wiped out on some of these positions within about a 24-hour period. What's your take on what's happened this week, Jake?
That again is also the wonderful reason why a lot of our clients are using the Deferred Sales Trust to diversify their assets, so that they have assets that they can pull money from should something happen to their primary source of income or their primary asset. A lot of times people utilize the deferred sales trust for the biggest sale of their lifetime, or for, such as this real estate individual we're going to talk about here right now, for a series of large transactions. In this scenario, well, let's just speak in general. A lot of our clients that we've been able to assist, they may have made historically, and I'm talking about some of the clients in the past, they made a very large, or they accumulated a large amount of assets doing one thing, and that might have been crypto. The advice that we typically give is to help them take what they've earned and be able to reinvest in such a way that, one, they can diversify, and two, they can secure some of their gain and reinvest it in other assets without taking constructive receipt today. Now, for our client who is watching some of her portfolio go up and down, we of course are trying to stay in contact and have these discussions and everything else, but fortunately she's receiving income every month from a stock portfolio. So her position is not necessarily as devastated in the sense that timing isn't against her. Even though her Bitcoin is suffering just like everybody else's Bitcoin, she has assets and income derived from somewhere else besides a W-2 employment job. And so that she's, I don't want to speak for her, but in her position, she should be comfortable because she knows that she'll have a paycheck coming in every single month, regardless of what the markets do today with her other assets.
Exactly right. And that's the power of the diversification aspect of the deferred sales trust, the cash flow, and the ability to defer the tax. And so very cool, Jake. Thanks for sharing that. And so now let me share my screen here. And now that I'm properly set up, sorry about the time it took to get that. But this is a deal that just closed in Phoenix, Arizona. And this property looks beautiful now. When they bought it, it was sort of needed some love, needed some value add, needed some facelift, needed a lot. And they put a substantial amount of money into the property, sold it for a huge gain. Now they were in a situation where they're GPs, right? So a lot of times people have a question, well, can this work for general partnerships with other limited partnerships? And can also the partners go separate ways? And the answer is yes. And so these guys are commercial real estate multifamily operators, syndicators, where they bring in funds and they manage and operate, run the business, then they pay back the LPs, and then they take their positions and go into their own deferred sales trust, which is really cool. Now, the other LPs also can do. In fact, one LP did join them. He was a bigger position. So there's typically just two, a guy named David and a guy named Jordan. And then the other one joined with a new client. And he was an LP because he had a big enough position. What's that position? Well, Pierce, what's the minimums that we like to see typically on size of deals?
Yeah, so the minimum is typically $1 million net proceeds and $1 million gain. And that's just because at that point, that's where the pain is high enough to where you can go through the due diligence process and go through all the things that we need to go through in order to get there.
Jake, can you do two at 500 each and combine it, Jake? What do you think?
You can do two at 500 each. You can do one at 800, one at 200. You can do one at 400, one at 600. The goal here is that we're getting an aggregate so that the tax pain of everything combined is sufficient enough so that this just makes sense, undoubtedly, without any really super big analysis. If it's less than that, it might be a base hit. And if you're okay with base hits, maybe if you get enough base hits, it still makes sense. But for it to be a home run, like no questions, hands down, good deal.
No matter what state you're in or what you're selling, right? Unless it's a primary home, right? That's the only little caveat, because if you've lived there the last 5 years, you have a $500,000 exclusion if you're married, $250,000 if you're single. Then in that scenario, you like to see like a $1.5 million to $1.5 million. Just make it a little bit bigger. Because why? Because we need that gain to cause the pain of the tax to be able to be deferred to make it make sense to hire us to do all the stuff that we do. So, all right. So that's our deal close story of the week. That's the vision. So now I'm going to open it up for questions or thoughts, ideas from anybody here. And so you can unmute yourself. You can also put it in the chat. Just state your name, where you're from, and then ask away your question. and we could just keep talking too, which is cool. We're happy to do that. But anyone have any thoughts or questions? Look at the full gallery.
I think Simon, who is here with us, has a very interesting client situation. I don't know, Simon, if you want to discuss that here with the group.
Sure. Good morning. My firm is based in San Francisco, California, but I'm currently in Colombia, so it's a little different. Oh, can you hear me now?
We can hear you the whole time. Everything's good.
Oh, if I hear me all the time. Okay, great. Then I have a client that is based in California, and he came into some real estate, and it's from his like long lost family in Germany. And so it was like a generation skipping thing over there or something.
I think we would all love to be your client right now. You know, somebody that we forgot about, we didn't even know existed, and they just
didn't even know existed.
Saying that
even know existed. 30-year-old guy sitting in San Francisco, working for City of San Francisco as an engineer or something like that, is like, oh shit, I'm just gonna inherit $5-10 million, right? So all this property in Berlin, it's like 5-7 properties. Some of it's multi-unit, multi-story buildings, right? Stuff that's been kind of acquired since World War II. And it's being split up between 7 of his unknown cousins, people he barely knows. Everybody has like different citizenships. There's some that are Brazilian. They're like a Jewish family. So it's like they all left the country, but they still held property in Berlin, or somebody there acquired property in Berlin. So you have this diaspora of this Jewish family, and it's all living in different countries. And he's one that is a US citizen and a German citizen. And so I think something like this, if that would be applicable or doable for foreign property, would be very interesting.
So there's another caveat here that really makes things interesting. So Brett, I guess in Germany, there's a rule that if you own the property more than 10 years or something like that, you don't have to pay capital gains tax on that in Germany.
Yeah.
However, money flowing into the United States from whatever source, if there's no taxes paid somewhere else, there's no foreign income tax to offset it.
Right.
So he's going to be fully taxed on the capital gains on the Obama 3.8 plus the state of California.
Yeah. Yeah.
And we know this because he's already had prior transactions where he had to pay all the taxes. Then he reached out to Simon.
Yeah.
That's heavy. Yeah, that's interesting. Yeah, because I have never done a deal like that, and that's this. I don't know if there's ever been a deal done like that with the deferred sales trust, but that'll be interesting to see, to explore what it would be. Typically, it means anything that's subject to U.S. capital gains tax can be deferred. I haven't seen it with an outside asset out of the country, but hey, it doesn't mean it can't be done. Let's put it in front of the brain surgeons, the tax attorneys, and see what they can do.
So we're looking to schedule it this Wednesday with Todd Campbell and yourself, Brett. Todd has already commented that this should be just like any other normal deal. The only concern or caveat would be if any foreign taxes were paid, of which we were able to find out that they haven't. So this, interestingly enough, obviously it's going to be split 7 ways. So I think
are the other cousins in the U.S.? Where are they located?
They're all over the place. I think there's some in Brazil, there's some in Europe, there's some in France.
Are we sure we're not cousins of these people?
Maybe we can find out. You have somebody in your last name Trout.
Let's throw my name in there. Yeah, that's really cool, man. What a neat story, Simon. That's fascinating. How did you meet this particular client?
I speak German. I have a little bit of. I'm half German. I'm family's from Berlin, so I'm familiar with the properties he's actually has over there, or where they're located. And so, my business name, if you can see in the background, is Kaufman Advisors. Kaufman is the German word for business person. So since that's who I advise, that's what I called it. And so, so I have a little bit of stuff on my website that makes the SEO searchable if you're looking for like international tax. And so I have quite a few German clients that I think they're just kind of oh, Kaufman. They kind of,
He's a business person. He's our guy.
yeah.
Love it, Simon. That's really cool. Yeah, and I'm originally from Mission San Jose, Fremont, so not too far from the Bay, San Francisco, and so cool. But I'm in Sacramento now, so we're just around the corner, so not too bad.
Nice.
So very cool, Simon. We're looking forward to that, and pleasure to meet you here. Any other thoughts or questions on that, or just in general the Deferred Sales Trust? Because I know you're probably still learning for the first time, and maybe everyone else can kind of glean from what questions you might have, especially as a CPA, right? I mean, it's a good source to start with.
Yeah, I'm just super interested in kind of how that's held up and how it holds up. What parts of the IRS regulations are being used to do that. And Jake explained a little bit about how it's part of the installment sales rules and stuff like that. But yeah, I'd love to see if this is a good fit for this client.
Yeah, and for everyone who's listening, right, this is really important, right? So Simon is a CPA. We can always learn something, right? But sometimes the false belief is, oh, my CPA knows every little part of this 10,000-page tax code. Now, Simon is definitely probably known installment sales for years, but he didn't know this particular nuance of the niche of partnering with the trust, essentially an installment sale, bringing them together and executing it on this behalf. And even if he had known about it, it's another thing to then know people who are actually doing it, right? Because sometimes as our clients, if they're moving too fast, they're like they're going 100 miles an hour on a deal. They're closing in 20 days, 30 days, or even in a month, or even on like a really $100 million huge deal. I got a call from a person this week who is looking at a property that I'm selling for a client who's doing a deferred sales trust. And he said he has a client and he runs a securities business in California, and they're selling a $110 million business in California in the next 4 months. And he had never heard of this. And so the biggest thing is when people are like about to do their biggest deal they've ever done, perhaps, and it has huge stakes, meaning a huge tax and new tax codes, and they go to their CPA, and sometimes they're expecting their CPA to have known about it or like literally jump on board right away. And they're like, well, hey, slow down. Like maybe haven't done it. And like, what are these things? And so this is why you want to be early. You want to be on these kind of calls to get comfortable. But some of the key questions are this, like, hey, how many IRS audits have been done, right? These questions you should be asking of us or anybody who has a tax deferral strategy. And for the Deferred Sales Trust, has been over a dozen no-change IRS audits plus additional formal audits, and even potentially up to as many as 20 or more combined if you look at everything that's kind of been tested. And the IRS and the tax attorney who's defended these particular audits and run through the things, literally they're batting 1,000. It's never once failed in over 25 years, which is really the kind of the second question you want to be asking, like how long have this been going on? You don't want to be in something that's only been going on for 25 months or maybe 2.5 years where it hasn't even really been had a chance to get the IRS maybe even see it, right? You want them to have seen it, have put it through the fire, through the test, through their audits. The next thing you want to ask is, well, how many have actually been done? The answer is thousands, okay, which means tens of thousands of tax returns. The next most important question is, well, what happens if I actually do get audited, right? Well, if you do get audited, the tax attorneys who created the structure will defend at no additional charge. They provide lifetime audit defense, right? So it's not just one thing to provide audit defense, is to have that perfect track record so far. And they do that for two reasons. One, they don't want the structure to fail, right? But two, they also want to be able to protect you, and that's state or federal. So those are some of the things that you want to ask. And if those other strategies don't have that, then it's you want to proceed cautiously, right? There have been others that have got blown up in IRS court, and we've never been on the Dirty Dozen or the IRS watch list. And we work with national law firms, other CPA firms, third parties that have looked at this on the outside and hired their own big national law firm and paid them hundreds of thousands of dollars. One was that for a deal down in Santa Barbara last year. It was a $45 million primary home sale. And that particular gentleman hired a California law firm, spent $100,000 of due diligence, and they came back and they gave him the thumbs up, and he did the deal. Another one is for a deal for Jake and I, a client who is a former IRS agent. Jake, you want to tell that story of that particular client and what's going on there?
Brett, I think you tell it the very best, but let me fill in some gaps as you go on with it.
Yeah, so he's selling a business at a SoCal, and it's about an $8 million sale, a zero basis. It's an online e-commerce tech sale. he does like barbecues, not really tech. It's more like barbecues and like the entire backyard, like remodel kind of thing. And he's selling all of that. And so he's done very well. Well, he loved it, and he was like moving fast with us. And then he said, you know what, guys, I need to have a third party that hadn't heard of this before. I want someone to start from scratch. And we said, okay, sure, as long as they sign the NDAs. And this particular person is a tax attorney, used to work for the IRS, and he found him independently. He signed the NDAs, and it took about 60, 90 days between the tax attorneys, with their schedules and everything. But he came through. He wrote an opinion letter, and he gave it a thumbs up. And he said, this is a really solid strategy. And I know, Jake, you've reviewed with CPAs over the years, different strategies. And so, I think that speaks volumes. Every time we've seen someone who takes the time to sign the NDAs to get with us, literally, I think we're like a 95%, 98%, they join us, and they give the thumbs up for as a CPA or tax attorney, giving some advice as far as to move forward or not. Jake, what do you think?
We have another client this Tuesday, Brett, that he has two different attorneys. He has his estate attorney and his tax attorney. He's coming to the table. It's actually a smaller deal, $2 million or so. And going through the process, ready to sit down with yourself, myself, the two tax attorneys, our tax attorneys, and all as a team collaboratively looking at it so that all the best minds around the table of this client can make sure that it's a good decision to move forward with. And we're more than happy to share with everybody very open-mindedly, very openly, without hiding anything. I mean, we all signed the legal paperwork so that we can all sit down and have good, knowledgeable discussions together.
Yeah, Pierce, I don't know if you're still there and if you're available. So what happens if, somebody ends up not wanting to do it? Like, are we charging for any of this? What's our agreement here for the conditions?
Way to tee that one up, man. Yeah. Yeah. So it's basically all contingent upon you closing the deal. So we can get all the way through, and at the very last second, you can be like, you know what? No, it's not for me anymore. And okay. So we only get paid if you close the deal. Yep.
And if the buyer backs out, we get paid, right? So we do everything on a conditional basis. So there's really like nothing to lose, which is actually really hard to find, high-level tax attorneys, CPAs, our team, to not charge any upfront cost and do it all on a conditional basis, which hopefully gives you some peace of mind to explore this with us. So that being said, Simon, any thoughts or questions on anything we just said? Feedback?
Yeah. So tell me a little bit, what's the purpose of the NDAs that you have, and like, why do you structure it that way?
Yeah, so part of it's just protecting the structure, right? For two reasons. One, we don't want competition, but number two, we don't want someone to take it and abuse it and then mess it up for all of our clients, right? Or future clients. So, in the past, these different type of tax deferral, different things, part of how they've been stopped or shut down by the IRS is because it started out as a good thing, and a fair thing, if you will, for both sides, if you will. And then somebody takes it and they press the lines, and then it gets abused and spread, and and then it's just it just doesn't show the form of it what it used to be. And the IRS says, oh, this is out of control, let's just shut it all down. So that's why it's been painstakingly protected. So hopefully that answers the question, Simon.
Yeah, and if I might just add to that, I like to eat a lot, and if there's like a world famous chef, that world famous chef, he might be willing to share his recipes, but at the same time, his recipes alone don't make him the chef. There's something about the guy that knows how to cook and knows how to put things together the right way. Not only the recipe is important, but the person doing it is incredibly important. The individual that has not just 10,000 hours, but hundreds of thousands of hours doing this one thing wants to maintain the quality. And we're more than happy to help protect that quality, simply because any other chef that might believe that they can recreate the same thing just from the recipe, it may not have the same outcome. And that will hurt the outcome for everybody who utilizes this. And I say that because in my experience of reviewing and vetting strategies for a variety of accounting firms across the country, all the things that Brett mentioned earlier on, has this been tested? Has this been reviewed by the IRS? Have they audited the IRS? What were the outcomes? What was the precedent of either when it worked or when it didn't work? And magically enough, for the Deferred Sales Trust, every single time they're batting 1,000. It has always worked. in the 10 or so reviews and the 12 or so audits, every time that Todd Campbell has had to come to the table with the IRS and represent this trust, it has come through with a 0 findings and a 0 change ending. And that has been incredibly important because that almost does not exist, as you very well know, Simon, that almost does not exist with any other strategy in the industry.
Yeah. And so this works with many different types of properties. I mean, you mentioned crypto, NFTs. We talked about real estate, business sales, primary home sales, I guess, which is pretty interesting because, a lot of different IRS types of strategies have kind of like almost like arm's length, types of stipulations where it can't be like there's different rules for your business versus your primary home versus something else, right?
Yeah, absolutely. And actually, we just did a duplex in San Francisco. That was, I think, a $3.5 million sale. Just did a $8.3 million primary home sale in Palo Alto. The duplex in San Francisco happened to be half rental, half primary. And so they had a little bit of the exclusion here, and then the rest of it, they were wanting to move to Hawaii, and they did. They did just this happened. That closed 2 years ago. And then Palo Alto, he was wanting to move to Nevada. That was a primary home sale. He was the number one realtor himself for about 30 years in Palo Alto, and he used it for his own house. And this is after a year of due diligence with us and the CPA and everything else. And he's like, his quote was, "Brett, you should share this with every luxury realtor. I can't tell you how many of my clients over the years, how much tax they've paid. I don't even want to think about it if they would have had this strategy." And then we've done Menlo Park. We did a $7.9 million deal in Santa Cruz. And so it goes on and on and on. Just closed a $12.75 million deal in San Diego 2 weeks ago. So the answer is yes. And then the key is early, right? Which is really important. So Jake, what's kind of the timing of everything to make sure that we get everything set up properly?
A lot of times the most critical thing is that we're able to get in front of the actual sales date. Typically we like 2 to 3 months, 2 to 3 months, prior to letters of intent being signed, but even, prior to people coming together and removing all conditions is the critical moment, right? I mean, can we step in at the 11th hour and try to make it work? We definitely can. And we have done that successfully. However, 2 to 3 months shows definitely proper intent so that should this be reviewed or scrutinized afterwards, we can easily say that the trust was intended from the beginning and it wasn't just an 11th hour tax deferral objective that was being accomplished.
Yeah. However, just to speak with that, like as long as the buyer hasn't removed all contingencies, because this does get confused, because I've had people call me and they'll watch another video online about, I think I've never actually met this other attorney, but they have this very strong opinion on it. And it's funny because they're not the one who created it and does the audit defense, but people watch it just because we're on YouTube or online, don't take everything we're saying as like, as gospel, right? But this particular attorney, in her opinion, believes it has to be even prior to like even a contract being signed. And it's just simply not true. And this is straight from Campbell Law. They're like, no, as long as the buyer hasn't removed contingencies, there's a thing called like a binding commitment test, right? Where like the seller, the buyer can basically legally compel the seller to perform, right? And which basically means that the buyer has removed all of the contingencies on his or her side, right? And the seller is just not going to perform because they don't want to pay the tax all of a sudden or whatever other reason, like that the seller is going to be compelled to sell. So as long as there's a contingency remaining and the seller is able to insert the Deferred Sales Trust, a specific trust, into the purchase and sale agreement via an addendum and actually form a trust, then we're good, right? And so that's the key. Like, when's the last time we could do it? Well, has the buyer removed all contingencies? Now, let's imagine they have. Well, if it's an investment property, are the funds sitting at a qualified intermediary? Is it part of a 1031 exchange? And then at that point, in fact, we use an exchange accommodator, Simon, right there in the city. That's one of our go-to ones in the country. And partly because they actually accommodate with the Deferred Sales Trust along with their qualified traditional 1031 services, right? Which is important because there's some exchange accommodators that don't want you to know about this. In fact, they write blog posts about why it's not legal, or why they think it doesn't work or whatever. And you're like, Well, of course you do. You guys don't want us taking your business. But remember, a 1031 exchange only works for investment property owners. It doesn't work for primary homeowners. It doesn't work for cryptocurrency, business owners. Doesn't work for public or private stock. The deferred sales trust works for artwork, collectibles, NFTs, all of these asset types. 1031 is blockbuster because it only works for a few. So anyway, so that's kind of the long answer to the question. Does that make sense, Simon, or any other questions there?
Yeah, that's pretty great. And then once that transaction has happened and the money goes into the trust, then it's what? Fully investable up to the client's decision of how he wants to hold the money, where he wants to put it. Or
I'm going to call in Rebecca on this one. I'm going to get her involved a little bit and see if Rebecca has a good answer to this, because Rebecca is one of our strategic alliances out of the Truckee Tahoe area, an expert luxury realtor. Rebecca, how are we doing?
Great. Excuse me. Great, Brad. I'm doing well. So to answer the question, a portion of the portion of the money that goes into the deferred sales trust needs to remain liquid. And then there's an additional portion that can be reinvested. And the client or the works with the trustee to figure out, and along with the financial advisor, what the best way is to do that. But yeah, if they have deals that they want to put together.
What can they put it into? Like what kind of properties, what kind of developments, what kind of deals? What can you put in, Rebecca?
Pretty much anything you want, as long pretty much as long as it makes, financial sense, I guess is the caveat. Yeah.
Very well said. And I'll just shift it a little bit. So that liquid portion of it, it's still it could be liquid investment grade securities, right? So it's more like liquid investments. So some people get it confused. They go, "Oh, I just stayed in the bank is going to make zero." No. Yeah, it can sit in the bank for a period of time until we find something. However, most and we'll put it in something like investment grade securities. That's where Jake Miller is the financial advisor to help with all of those things, a securities professional. And so still your money, still earning interest. Okay, so you're not losing on that. Now the other 80% is more flexible, such as you can put it back into real estate ventures. You can put it back into some cryptocurrency. You can put it back into some hard money lending. You can put it into a business venture. Jake mentioned the client of ours who sold the $5 million of Bitcoin. By the way, when it was at $54,000 a coin, looking like that, she's looking like she's brilliant, right? Because now it's, I think, they went to the 20. I think I saw it at 29,000. I think that was today or yesterday. It might be still there.
25.
Is it 25 now? Wow.
No, it shot back up to 30, but it hit 25.
It hit 25, yeah. So that's kind of brutal, right? So think about that. She sold it at 54,000 a coin. That's more than 50% of the low at 25, and she exited at 5 million. So that 5 million would have been 2.5 million. So she exited at 5, deferred two of that 5, basically. That was her tax, 37% or so, about 1.85 million. Now I will say too that I did encourage her, and I don't blame her because she was just still getting to know us. But her 50 million when she exited at 54,000 a coin went to 45. Now that 45 when the Bitcoin went to 68,000. Of course, this is the Monday morning quarterback, right? But I just want to let you guys know what's actually possible. 69,000 I think is the high. It hit. So that 45 probably would have went to, I don't know, $63 million. Monday morning quarterback, you literally sell all $63 million. You put into the deferred sales trust, and then you wait for Bitcoin to drop to 25,000 a coin, and then you use a big percentage of this to buy back in at a low. Okay, and I think is that making sense there? I think someone's. I'm gonna mute.
Correct.
Yeah.
Yeah.
Pierce, you there? Something to say?
Yeah. I was trying to get into that. Just wanted to speak to that a little bit.
Yeah. Jump in.
Just to say, like, I know a lot of people think oh, that sounds like too good to be true, and whatever, that can't happen. But you literally have a story, and I tell it all the time, of how it actually did happen. The guy back in 2006 who had that $20 million apartment complex, and then ended up selling it. Tell the story,
Pierce. Tell the story.
He sold it, man. He did it. He did the DST. He did 1031. He couldn't find the up leg, all that stuff, and he ended up doing it. He deferred a bunch of tax. He put it into the DST, and then and then in 2012, he got a call from the bank and they said, "Hey, we're foreclosing on that buyer. You know, you want to buy it back?" He's like, "About 40% off? Yeah, I'll do that." And JB partnered with his trust and redid it. And I tell that story a lot just to say, like, you know, and it's not like that happens every day, but he was positioned correctly, right? Like, luck is where hard work meets preparation and opportunity. And so, like, if you're set up for success like that, and you have the tools and you have the systems and you have the structure in place, you can execute on things like that. So yeah, you can, when Bitcoin hits 25,000, you can put a bunch into it, you know? So for those who are like, oh, you know, the timing thing is not a big deal. Like, it is so important in any sort of investment in a business deal that you have timing on your side, and to be able to control the timing is unbelievable, because it's the one thing you can't get back, right? Like, it's not a renewable resource. And so having that ability to control it as best that you can is so powerful.
Love it, Pierce. You couldn't say it better myself, my friend. You are learning. I feel like I'm Yoda, right? And you're Luke Skywalker. So keep it up. Jake, any other thoughts on that?
You know, everybody's situation is different. Just to reiterate again, Simon brought up a good point. A lot of these strategies are business or personal, like they don't mix a lot. This particular strategy is all about an asset that is appreciated, like a capital asset that is appreciated greatly over time, or it could be over a short period of time, over a long period of time. And so it can be a personally owned asset. It can be a business asset. It can be shares, it can be crypto, it can be NFTs, it can be paintings, it can be a number of different things. And so this is truly a solution and a financial tool that can help accelerate the growth of future investments, simply because we control the timing of if and when we pay those deferred taxes. And that is very powerful, because then we're able to reinvest a greater percentage of our assets going forward to produce more income, more jobs, more overall wealth. And that's critical, and that's important for all of our clients that we work with.
Yeah, and the idea here is tax flow versus cash flow. We've been taught to just talk about cash flow. It's all about cash flow. Well, it is, but it's even more important that it's about tax flow. In fact, the largest wealth transfer in the history of the planet is happening right now, and it's the baby boomers. And in fact, they have about $32 trillion over the next 18 to 20 years that's going to transfer to the millennials. And these are tied to mostly high-end primary homes, businesses, and commercial real estate. And then you have these crypto millionaires, right, and crypto billionaires that have a lot of assets too. And so you got to look at not just cash flow, but tax flow in the perspective of estate tax. Estate tax is a big challenge right now for people that have more than 22 million married, 12 million single. It's not necessarily on the forefront of people's minds because it is about death, but it is something to consider, right? If you can exit in one day without buying a bunch of life insurance or giving it all away to charity, or having to have a bunch of kids to try to gift it away, you can create a situation where you're exiting literally hundreds of thousands to millions of dollars of tax with the Deferred Sales Trust 2.0. In fact, that's the deal. It inspires me. I'm going to call the gentleman back that I talked to a couple of days ago on a $10 million deal and let him know that, yeah, that's 40% death tax is going to be eliminated, right? In one day in 4 months when he sells. Otherwise, if he doesn't do that, he's maybe deferring a capital gains tax if he's able to do a 1031 exchange, but it's not as if you can just transfer that over to the Deferred Sales Trust 2.0. You actually need to exit at the time. It's like the fourth quarter, 10 seconds to go. Like, you have one chance to do this and get it all outside because it's changing the characteristic, and you have a third-party buyer. And so that's the other thing we want to talk about is it's tax flow versus cash flow. It's estate tax challenges for ultra high net worth clients. And it's also capital gains tax stuff. It's not just capital gains tax. It's also estate tax. So that being said, anyone else? Simon's had some great questions and thoughts and discussion here as a CPA, but everyone's invited. No questions are bad questions. We're here to answer them. In fact, I think we have something in the chat here.
Hey, Brett, real fast. I got to bounce. I got some people here in person that we need to go over to EST.
Good.
Appreciate everything that everybody does every week coming to this meeting. And of course, Brett, capitalgainstaxsolutions.com. I have Strategic Tax Solutions. You can reach me at my 1-800 number, 1-800-773-1848. Appreciate everyone here. Simon, thank you for coming today. Brett, thank you so much for all that you do. And we'll be seeing each other with a few clients here these next couple of days.
Every other hour we're together, Jake, I feel like. So, yeah, I'll see you soon, brother.
All right. Thank you.
So we do have a question here from, let me pull it up again. It has to do with non-U.S. residents. And it says, it's from Angie, does the Deferred Sales Trust have any regulations towards non-U.S. residents? Are non-U.S. residents eligible? This is a great question. And in fact, it's even better for non-U.S. residents, okay? Now, the key is what they are selling or exiting subject to U.S. capital gains tax. So no matter if you're Canadian, if you're from Europe, whatever other country, it doesn't matter. If you have assets that are subject to U.S. capital gains tax, which typically means like businesses or real estate that are in the U.S. that you're going to exit from, there's going to be capital gains tax. Yes, you absolutely qualify because the asset is subject to U.S. capital gains tax. Now, why is it better for U.S. residents or non-U.S. residents? Well, you got to look at the estate tax. So the next question would be, well, what's the net worth of the individual? And they go, well, they're worth more than 22 million married or 12 million single. Well, it's not even that anymore. It's literally like I think it's $65,000 or $68,000 if you're a non-U.S. resident. So let me paint that picture. So let's say, I'm married, okay, and my wife and I, let's say our estate's worth $52 million, which is not, but maybe one day, right? If I were to die tomorrow and she were to die tomorrow and all of it's inside of our taxable estate, that extra 30 million above that 22 exemption is going to be hit with a 40% death tax. So that's $12 million. Has nothing to do with the stepped up basis, has nothing to do with the 1031 exchange or capital gains tax, has everything to do with estate, what's your total estate at the time of death. Now, check this out. Let's imagine I wasn't a U.S. citizen, right? Or someone else is, and they have the exact same situation. They have no exemption. So on $52 million, they're subject to 40%. That's $20 million, almost $21 million. $20,800,000 would be their estate tax because they're not U.S. citizens, right? Which is incredible to think about and feel like highway robbery, right? But that's the reality. Like as a U.S. citizens, we got some cool stuff. So this is why the Deferred Sales Trust Plus is like even more of a home run for non-U.S. citizens. Angie, do you have any questions on that, or is that making some sense?
Yeah, it makes sense. So for non-U.S. residents, because I deal with the majority of my clients are non-U.S. residents, and a lot of them are looking to invest properties in the U.S. market. I have people from different parts of the world. And of course, everyone has different regulations according to the country that they're coming from, right? So my question was, does it work for non-U.S. residents if they're looking to buy properties, investment properties, multiple different properties in different states? If they want to go into cryptocurrency, I have a couple of them that are into cryptocurrency, NFTs. So, just trying to see how would that strategy work with them when they actually do have to file, a non-U.S. Income tax return.
Yeah, that's a great question. First of all, it all depends, right? Every single circumstance is a little bit different, right? So what you brought up is kind of like on a Rubik's cube, and different countries, different citizenships, different situations, and it's kind of all a little bit jumbled. And that's part of why we're here to do what we do. Is we hope to bring in the best to start to move this around, all of us together in a room on a Zoom these days, right? And to try to get as close as we can to congruency, right? What I can tell you is the Deferred Sales Trust, again, works for all, no matter where you're from. It works as long as the asset that you're selling is subject to U.S. capital gains tax. Then at that point, where and how can the funds be invested? Well, it's very flexible. It can be back into stocks, bonds, mutual funds, real estate, cryptocurrency. It can be in the U.S. It could be out of the U.S. for real estate. It's flexible, okay? So hopefully that answers the question there, Angie, so far.
It does. Thank you.
Yeah, so bring the client, right? The biggest thing is bring the client, right? Because again, if you sit down with us, no cost, no obligation, we'll sit down, we'll go through it all together, and we'll line up a side-by-side comparison of not use the trust or use the trust, and then say, here's the cost, here's what you're subject to. Now, their particular, how they're going to file overseas with that, we're not, we do everything in the U.S., so that would be between them and their the powers that be that they're subject to, right? But again, if their asset they're selling is U.S. capital gains tax, then we can help them defer that capital gains tax and then move it outside their taxable estate for the U.S., which is incredible. So, okay. Looks like we got Jake unmuted. Jake, welcome. We got another Jake. We got another Jake that I work with up in Washington. Jake's a good name, Jake. Jake Carpenter. Jake, how are we doing today?
Great. You were, I was taken back a little bit there. Every once in a while when you'd say Jake, I'd be like, oh, is that me? Yeah. So let's take it back, just rewind just a little bit. And can you talk a little bit about a 1031 exchange where they're in a 1031 exchange, they're with a facilitator that does not or is not familiar with the defeasance agreement and how to fail into a deferred sales trust. What is the process there?
Yeah, it's a great question. And so, by the way, it's a great reminder for everybody to make sure you're working with professionals that can actually have an option to solve your problem, right? So if I were to walk into a doctor's office and I have an ACL surgery, right? I blew both knees out, played college basketball, and I had to get taken care of. I had to get new ACLs. And if I'm walking into a general practitioner to say, hey, I got an ACL, can you cut me up and do it? And they're like, well, we've never done it. And then, okay, and we don't do it. Okay, and then I'm in the wrong office. So that's the first thing is like, you get to make sure that the people that you're working with, can they actually work with the deferred sales trust? Have they actually done it? Right? And if they haven't, then you're in the wrong doctor's office. You're in the wrong 1031 qualified intermediary. Now, some of them will have their opinions about it, but then you ask yourself, are you a tax attorney? Are you a CPA? I thought you were a qualified intermediary. Like who, so also realize that they're probably the wrong professionals to even be talking about that with, right? Make sure you're working with a tax attorney and a CPA. This is what our team, our partners, business partners provide. We provide it all. I'm the trustee on this, but we provide all of that. So now, are there qualified intermediaries that allow this? Yes, absolutely. That's the ones that we work with, and those are the only ones we work with. We will never send a deal to any qualified intermediary that doesn't allow our clients to have the option for a deferred sales trust. So, but to answer your question, Jake, and get with us, go to capitalgainstaxlist.com and get with us, and we'll provide all of those strategic alliances. So to answer your question, if there are qualified intermediaries, and there are times where they literally hadn't heard of it, they don't know about it, but they're open-minded enough to sign an NDA and to work with us. In fact, I did a deal in Texas, okay, for a client. They sold thousands of acres, and they did a partial 1031 and a partial deferred sales trust. This particular qualified intermediary had never heard of the deferred sales trust. There's no fault to them, but they were open to sign the NDA, and they were open to accommodate and work with it, work with us and work with their client. And we got on a call with the qualified intermediary. They signed the NDA. We reviewed their exchange agreement. We proposed some language. It's about a paragraph. We inserted it into the exchange agreement. And then they were able to send the remaining funds on day 181 for this particular accommodator into the deferred sales trust. So that's kind of the short answer, Jake. Does that answer your question so far?
Yeah, it's kind of for everyone's benefit, but so the process is to get you on a call with a qualified intermediary or to get the tax attorneys on the call.
You nailed it. Yeah, just make the introduction, right, and make sure the funds are staying at the qualified intermediary. Make sure they're not sending them back to the client yet. There's a couple windows to keep in mind. The first 45 days is your identification window, of which if you haven't identified property, then on day 46, a lot of accommodators will just send you the money back, which is then it's all over. It's taxable at that point, right? However, if you had identified something, that means they're going to typically stretch it out to day 181, which is actually a good thing because it buys us an extra 135 days to set everything up for the deferred sales trust. So the key is, again, this is a Rubik's Cube, right? I just said a lot of complex things in a short period of time. The key is get with us so that we can at least start to move this thing around where the colors start to align and we can keep what's called options open. Imagine there's like a hallway and we want to create these little doors along the hallway so that at any point along the hallway you can just exit, right? You can exit into the deferred sales trust.
So if they have not identified a property within 45 days, can they still request that the qualified intermediary keep the funds and keep this thing going?
Good question. It all depends again. Now, some qualified intermediaries just have by default, they're just going to send the funds back. Some might still allow it. That's kind of a little more technical. So if the funds are still there, tell them to keep it there, and then let's take a look at the situation and let's see if we can still do it. But from the deferred sales trust standpoint, there's nothing in there that says, oh, you've had to have done these things in order to use the deferred sales trust. It's more so the qualified intermediary standpoint. So that's kind of technical, Jake, but I would say just do it on a case-by-case basis and let's see what we can do.
So initially, it's basically in the first 45 days, we want to put you in contact with a qualified intermediary to begin the conversation of what do we do if this thing fails?
Yeah, it's never too early for us. Like, get with us now, right? Because we don't charge, it's all conditional. We only charge if it closes. So if it's prior to you closing, just use a qualified intermediary that already works with us so you can just avoid all of the confusion and all of the heartache here. But B, if you've already used somebody else, then let's just get with them now and let's try to time this thing so that it can be, it doesn't feel like it's a fire drill. Good question, Jake.
Thank you, Brett.
Yeah. So we've got just a few minutes left. I want to see if
got
anyone
another
else.
situation to see if this would
Go,
be
Simon.
applicable.
Yeah.
I've got another client. They have a company related in the solar industry, and they're doing pretty good revenues. And so they really have a lot of upside potential. And because of that, they're having outside investors come in, and they have a private equity company that's going to put a lot of cash into the business so that they can scale from 5 million in sales to like 30 million, 50 million in sales. And so because of that cash infusion, the original founder is going to be getting out something like a few million, $5 million. Now I'm looking into seeing if the section 1202, a capital gains tax exclusion, can work. But there's been some weird history with the shares and different owners and stuff like that. Would this, situation work with a DST?
So it all depends. So it works for public or private stock. So and it works with S corps, LLCs, C corps, partnerships, LPs. Again, this is like, it's not a one size fits all. It's going to be dependent upon a lot of different things, but this is why we do like an x-ray of the deal, and then we try to see if there's a way to make it congruent with their situation. But everything you're saying so far seems like it would work just fine. There's nothing that is a red flag there, as long as we set it up prior to, again, them receiving or having what's called constructive receipt of the funds on the exit. You've told me though it's in the future, it's not closed yet. They're in the process of doing everything. Right. And so what we would do is we would look at the asset purchase agreement, or however they're doing this particular deal. We'd work with the M&A attorneys, and we'd work with you, and we'd insert the trust, form a brand new trust, insert it into the contract, and basically assign the interest of what was due on that 3 to 5 million is how I see it kind of being mapped out with the tax attorney.
Okay.
So at close, the funds go to the trust. The price purchase is going to him. That's how it stays tax deferred. Just kind of like a 1031 in that scenario.
Cool. And so once it goes into the trust, he has some obligation from the PE firm that they need to put some money back into the company as as liquidity, as a loan, but that can just come out of the trust. And that's not a problem.
Yep. You can always get distributions out of the trust, and it might be taxable in that scenario. Or if it's going back into a business investment purpose, then you could, and he's an active GP, even if he's not an active GP, I mean, it kind of depends. We might form an LLC, have him partner with the LLC and go back in. Or even prior to, we would just carve out that amount. So we would say, hey, this amount, instead of paying 5 million, pay us 4, and let that other million just roll with NewCo, if you will. And on NewCo, then we could own that 1 million goes to 5, let's say in 10 years or whatever. That could also exit on top of the trust as well. So the key is building the foundation, kind of what Pierce was saying earlier. Let's build a foundation based upon the facts pattern that we have, based upon what they want the outcome to be, and then go from there, if that makes sense.
And it's only taxable to him once he wants to take distributions out of the trust.
Correct. Exactly. So as soon as he takes distributions is when he'll actually pay some tax. And as he takes interest distributions, he'll pay ordinary income tax, 1099. He'll give that to you to report on the personal tax return. If he dips into principal, he'll pay capital gains tax on that given amount. But most of our clients are keeping the principal. We call it the golden goose that lays the golden egg inside the trust and just building on those investments, inside those investments. And they just live off the interest. Interest payments are typically as high as 8%. Most are taking 5 to 6, and they keep a little cushion between the 5 and the 8. Just depends on their risk tolerance, depends on their income needs, and that can also be adjusted along the way on the DST 1.0.
Awesome. Cool.
Great question, Simon. That's a great way to wrap it up. Hey, everybody, I want to thank you for attending, for joining, for participating, for your support with Capital Gains Tax Solutions. And I want to encourage you to continue to dive in with us, invite somebody next week, and check out the new book that's coming out soon, Building a Tax-Deferred Exit Strategy. We got Kevin Harrington from Shark Tank is going to be in the book. Also, Jake Miller's in the book, and a bunch of other commercial real estate people are in the book. So you can check that out. It's coming out in the next 30 days. And go to capitalgainstaxsolutions.com if you want to get started with your deferred sales trust. And we will talk or see you next week. Thanks so much, everybody. Bye. Take care.
Thank you.